The economic cycle comes with periods of boom and bust. Sometimes prices are up and things are smooth. Other times prices are down and things become a bit difficult. The goal of the investor is to persist, to ride the wave going up and weather the storm coming down. But that's easier said than done. Well, not until now. With me today is Angela Odo. Angela has 15 years worth of experience in commercial banking, in the retail and corporate banking for large companies. Under her belt are big names like UBA, Unity Bank, and Taj Bank. Today, Angela will walk us through building a portfolio that persists through economic downturns. When she's not managing wealth, she's keeping her brains firing with chess and Sudoku or winding down with webtoons. Angela, welcome to the Market Lens.
Thank you.
All right, let's set the scene before we begin. What does resilience mean? I mean, take into cognizance the economic realities in Nigeria in 2025, right? Prices are high, interest rates are still kind of high, and things are a bit difficult for the regular consumer. What does resilience mean in this context?
In this context, I'll say resilience refers to now how much shock you can absorb. It refers to how much risk you can take and not fall flat to the ground. So resilience now is not just about being risk averse or reducing risk. It's about how much really of those risks are you prepared to face and still keep going, and not just keep going, but keep going successfully, at least to some extent.
I like that you say risk, because immediately you say risk, the first thing I thought was, okay, high risk, low risk. Because I know I've had conversations with other people that, they talk about, the level of risk. But now what I believe you're saying now is, it's not just about whether taking on more risk or less risk, but is it the type of risk or how adaptable you are to that risk?
It is how much you can adapt, how much you can adapt around the risk. It is like you predicting that risk and preparing for it. So you are not just in avoidance mode, you are conscious that this risk is going to come or might come, and you have prepared yourself to absorb it when it comes in. So it's not avoidance, it is being adaptable. It is being like a shock absorber, basically.
Okay. So now, are there specific assets, right? Because this concept of being able to absorb shocks, right? Does it happen more on the strategy level, like it's how you see the markets, or it's how you view assets, or there are actually specific types of assets that's okay, these assets absorb the shock?
In 2025, it has become everything. So because the risks now are abundant, we've gone through so much. We've gone through COVID. We've gone through a ton of things. So risk is free. It's out there. It's open. So now you adopt everything, all the strategies. So at strategy level, while you are constructing your portfolio, you make room for shocks. At the same time, there are types of assets that you can actually, put in your portfolio construction that are programmed to absorb shocks. Those kind of assets, sometimes they are now, when you talk about hedging. So when you have hedged, which means that you have begun to look at, say, derivatives, their job is to absorb shocks. So the kinds of assets you can invest in that will absorb shocks.
All right. So let's look at some of the shocks that we've had, let's say over the last 3-4 years, and then we'll focus on 2025. Right. We had COVID, we had, oil prices, and I think that was chiefly in 2021, 2022, although we had one or two, stints of, oil volatility this year. And then we've also had, what else? Global, rate spikes, even interest rate spikes last year. Now, with all of this that has happened, the definition of safe investments in Nigeria, has it changed? Or is it still the same, but maybe a little bit moderated to absorb or account for these shocks?
Okay, everything changes. The words, they remain the same, English is expanding, but it's not expanding as much as maybe it should or could have. The words remain the same, but the time now defines what that word now means. So safety, I would say in 2025, and then given all that we've experienced in the last 4 years, has shifted from trying to uh, protect yourself against risk, hide from risk, basically. So if I was to use an analogy, I would say safety before now for a person would be to say, stay indoors, lock the door, don't go out at night, and so on and so forth. So you are protecting yourself from the risks that could, happen. But now in 2025, risks are abundant. I could sit in my house and I don't have wars are no longer fought by me coming to meet you anymore. We've gone from pitchforks to guns. And right now I can sit in my house and I could press a button and your house goes from existing to not existing. So just how much can you do? You can't keep running around. So safety now is about how much you can adapt when those things happen. So I'd say safety is now adaptability. To be safe, you need to be able to adapt. You need to be able to shift, survive, despite what has happened to you. That, I would say, is what safety is in 2025. Now, if we relate this to the financial sector with rising interest rates and so on and so forth, safety is now about how much can we do to ensure that when risks occur, because they will occur, we will be able to survive.
Okay. I like that. I like the initial analogies. Actually, we're pushing the button to get things to blow up. But yeah. All right. So let's talk core strategies.
Okay.
Right now. All right. If the goal is to be able to adapt, first things first is any way to see these things coming. I mean, of course, nobody has a crystal ball to see what's going to happen or all price spikes are going to happen. But is there a way to kind of prepare just in case?
Yes. Okay. So before answering your question, I'll back up a bit. So now, for an investor, what you're doing is what is called portfolio construction, in the sense that the portfolio is more like a briefcase. You have a briefcase, and then in that briefcase, you begin to put in valuables. Now, say you put in a bar of gold, some sacks of rice,
A Rolex.
a Rolex watch, and so on and so forth. You put in some land documents. Now, the collective value of all of those things you've put in your portfolio is what that briefcase is worth. Now, in order for you to think safety, think resilience, you are looking at how much can happen to this portfolio, this briefcase, and still, I can still be comfortable to say I am still going to, have the same value as I set out to have at the end of a certain period. So can this briefcase fall to the ground? If it falls to the ground, will it just shatter? And there goes my Rolex. And so on and so forth. So there are certain things you can do in that briefcase. One of it, talking of core strategy now, is diversification. So diversification is just an instance where you have in that briefcase valuable items, but they are not the same. I don't just have that briefcase chock full with gold. So if something happens, if the evil men and women at the gold market finally succeed, if there are evil men and women at the gold market, there goes all of my value. So I have gold, I have rice, which we call commodities. I have some stocks from maybe some banks or some corporates. I have real estate, which is some land document and so on and so forth. So everything cannot crash at the same time. Yes. So then I also begin to think about the next strategy, which is to ensure that those assets in that briefcase, they do not closely resemble each other. not the same thing, the same event cannot take them all down. That's where we talk about correlation. We would need to ensure that the correlation between those assets are quite low. So if, say, rice is taking a beating, maybe real estate is going up. So we can do all of that. So we reduce the correlation between the things in that basket. Then the third thing we need to also do as strategy is to try to also remain liquid. Now, in that basket, there should be some items that are close to cash because, like we said, it is about adaptability. We don't really know what will come. So, what if I now need money suddenly? And in that bag, I have gold bars, I have land documents, and so on and so forth. So, I'm probably forced to sell one gold bar at whatever I can get now. Maybe someone's at the hospital. So I could sell at a loss, reducing the value of the portfolio. Okay, so but if I had something that is close to cash, I could pull that out. So one thing that is close to cash could be fixed deposits in a bank. I could say, okay, liquidate my fixed deposit. So at that point, I will be getting the value of that deposit at that point in time. So I could use that. So that's liquidity. Then the final thing is hedging.
Okay. What is hedging?
Hedging is a situation where you get insurance on your money. You get insurance on your assets. So it's kind of insurance. So you have put this in place so that whatever those risks are, those that you can predict, and those that you cannot predict, when they come, say you crash your car, the insurance will pay for the crash. So you don't really lose much. Maybe what you have lost is you don't have a car for a day or two. So you have protected yourself. You can then quickly buy another car. But yes.
Doesn't that cost more money? I mean, if I have to pay insurance on my car in case I crash it, can't I just invest that money and drive safe?
Well, you could drive safely, but you can't tell what the next driver is going to do. Even if you, say, take a mile per 10 hours, someone could just suddenly come and then that's it, an accident happens. So you cannot predict per se that you will be safe on the road. So that money you have used to purchase insurance is actually an investment. It's an investment to ensure the value of that portfolio remains despite shocks. So that's where hedging comes to play. So there are different ways to hedge. There is currency hedging, where if you have some money in that briefcase, you don't have it all in one currency. So if there is that guy who presses the button and that country disappears, so their currency has disappeared. They now have investment in midnight. But you have other currencies in that portfolio, and some of them could be getting stronger and even stronger. So it could cover for that loss. The next thing could be hedging, where you can hedge against market risk. Now, to hedge against market risk, there's simple things you can do. Maybe you go to derivatives. Now, derivatives, what they are, they're just financial contracts.
Okay. Let's wind up a little bit, right?
Okay.
Because we said a lot of really good things, but I want to talk more about hedging. Okay. But first, I want to talk a bit more about correlation, because I feel like liquidity is self-explanatory, right? But correlation. So take the analogy of the briefcase rather, the bar of gold, and documents, the currency, and the Rolex. 24 major, and the rice. But yeah, the rice. So these things sound like very different things. And with these analogies that you've given, it's very easy to see that they are not correlated. I don't think the things that affect the price of gold will affect the price of rice. But the average person who only buys rice to eat and not to invest in, and can't afford a Rolex, and has probably never seen gold in his life, what are some of the assets that they know? So you have stocks, you have bonds, you have maybe treasury bills, you have mutual funds, right? Can we just talk a little bit more about the, I guess, level of correlation, right, between some of these more available assets in the market?
Okay, you're absolutely right, because in that analogy, in as much as those items don't seem similar, they actually are. They're commodities. So it means that you're actually investing in one asset segment. So it means that your risk is still very much available. It's still very much there. So for existing assets, you do have equities, you have mutual funds, you have investment, straight up in foreign currency, that's forex investments. So all of these. Then you have, when we say equities, now we're referring to shares in, say, different organizations. You have shares in banks, you have shares in corporates, and so on and so forth. So now to talk about correlation, a share in, say, an oil and gas industry and a share in the banking industry, in as much as they're all equities, the level of correlation is somewhat medium. Medium in the sense that they are ownership in different industries. So the decisions that might affect banks, maybe capitalization, might not in the immediate affect the oil and gas industry. It might get there because in the end, all roads lead to the bank. Because of course, money still go back to the bank, lending comes from the bank, and so on and so forth. But at that point, you are not immediately impacted. The shares of oil and gas might still be up there. So while the banks have, probably slipped downwards. So that's correlation. Mutual funds, that's something else that, it is. Mutual funds is basically the pulling together of money to invest now in all the asset classes. So that is already you putting your money somewhere that the whole goal is to diversify. So in that space, it is already diversified. So the risk of ups and downs are already reduced. So what you've done for yourself is you've invested in equities on your own. Now you've invested in mutual funds, which is a diversification. Then you can also invest in other things like bonds, fixed income instruments. So you can invest in bonds. This could be corporate, it could be government bonds. Then, of course, there are the other things, T-bills, treasury bills, and so on and so forth. Now, the correlation between all of these is quite low. Quite low, yes. They are not, number one, they're not from the same issuer. So if something happens to that issuer, you're still fine from the other issuers. Then they're not also even investment in the same things.
Now let's move to hedging, because I like the concept of hedging, right? But I really, really want to understand. Now I understand the concept, the analogy of insurance that we gave. Like if I have a car, if I buy a banking stock, how do I hedge?
All right. There are now we'll talk about derivatives. So there are financial contracts that you can take. When I say take, you can buy. You buy them on the NGX and so on and so forth, the same way you buy those shares. So one of them they are called put options.
Okay.
A put option it gives you the right to say, even though I'm buying Angela banking industry share right now, only I have the right to at any point sell it at this amount.
Okay.
So from get-go, I have bought the share, I've gotten the share. At the same time, I have gotten an insurance on it through what is called a put option. It is a derivative. It is what then happens is, if something happens to the banking industry, while others have to sell at whatever the market is at, I can choose to exercise my right to sell at the rate that I have gotten on that put option. Yes, so that's one thing you can do. Then, besides that, which is one of the most obvious things you can do, then you now go back to diversification and the rest of those, because that now is a form of hedging. So hedging is just like putting a bubble wrap around the assets that you have.
All right, so back to at least the parts of the market where the average person can do a little something themselves. Let's say I was a regular retail investor. I hold stocks. How do I now know that, okay, what I'm beginning to see is maybe just a pullback, just a slight bump in the road, or the beginning of something that will come to wipe out my entire wealth? So first, is there a way to gauge that? And then how do you go about that in terms of your liquidity?
Okay, I'm assuming that this investor is already coming from a diversified standpoint, because what will increase the frenzy is if that's all you have. So I want to assume first off that this investor is already diversified. Then the next thing to do is to think long term. It is always important to think long term. The only way to gauge if something has come to stay is through time. So the first thing to do is to set for yourself the lowest you can go. So don't say now, right now. No, it means you didn't plan. You need to plan at the get-go that this is my stop point. If it gets to this point, I'm out. However, if it doesn't get to this point, I can still wait. Now, for an economy, even before an economy is declared as a recession, you need to have negative GDP twice, back to back. So it just tells us that for everything, before you conclude, you need to wait. So when things start with C cells like this, I would suggest the first thing to do is to wait and then hope on that diversified portfolio. Yes.
Do you feel like a lot of Nigerian retail investors are under diversified? They're not sufficiently diversified.
Yes, I think so, because I think even the subject of diversification is unclear. Sometimes people assume, now naming names, that getting a share in a bank A and getting a share in a bank B is diversification. So sometimes we have a portfolio filled with different things that are actually the same. So now you're exposed to industry risk. So it means that the diversification was incorrectly done. So I actually think that there needs to be clarification on what diversification really is, so that it can become the norm for the retail investor.
So let's talk a little bit about, mutual funds. Earlier you talked about mutual funds, and you said that those were, at least of all the assets that we've talked about, those are the ones that are most likely to be sufficiently diversified, right? So mutual funds.
Okay, so mutual funds there are two angles of diversification that has been created for the public. Why I said two angles is because there's mutual funds on one hand, there are ETFs on another hand. So ETFs being exchange trade, so there are ETFs on another hand. So mutual funds is where I say, everybody bring your money. We pull it together and I go and invest it for you. And then in that space, because I have a big basket of money, I'm able to, now expertly invest in different things, buy different assets. So I can so when all the ROIs, all the returns come on these assets, I pull them together and share for all the investors. So at that point, the fluctuations, the volatility in those assets has been covered. You have sort of provided for it by saying, when this goes quite up and this goes quite low, I take all of this together, it averages out, and I share for these investors. So in those mutual funds, in those investments, you have treasury bills that is crashing or crashed and it's coming up again. You have every asset you can think of. So the administrators of those funds have gone out to expertly buy assets and then come back and share the proceeds of those investments to everyone in that fund. So the investors are able to retain high rates because of all of the application of funds that went into the investing process by the administrators of those funds. Another diversification, like I said, that has been prepared for the public at ETFs. So in that case now, while you have pulled together funds for mutual funds, in this case now, someone else has bundled together assets. Yes. So an ETF is just a bundling of assets to say, I will sell to you one diversified component. You can buy 1 unit of this, buy this one basket, but in it, I have a lot of assets. So that also is diversification.
So now on the funds that we've talked about, are there any specific type of funds, not naming names though, just the types of funds that have been resilient through either total economic turmoil or specific or turmoils that affect specific markets, like maybe funds that have been resilient through currency devaluations, or funds that have been resilient through equity bear markets, or even maybe periods of low rates or maybe very high rates.
So without naming names, there really wouldn't be anything to say to that. I'll just say yes to the investor. The fund that we're looking at should be a fund that is widely spread, in the sense that it gives the administrator the room to go wherever they need to go in order to remain resilient and profitable. Now, some funds are specific to certain things. You could see that this is an infrastructure fund, this is an ESG fund, etc., etc. So now that on its own is a restriction that might cause you or the investor to be at a disadvantage if something happens to that specific economic segment. So I'd say go, if when making a choice and you have limited resources, very risk averse, go for funds that are just mutual funds with that has given the investor or the administrator free will to administer. Yes, freedom to administer. Yes.
Earlier you said infrastructure funds, and I know that right now there are a lot of infrastructure projects that are planned for Nigeria, here. And when I think about infrastructure funds, I think of halal funds. So let's talk a little bit about halal funds. What's a halal fund?
All right. Halal fund is at its core investing that is guided by principles that are just three of them. The first of it is you don't want to invest in things that yield interest.
Okay.
You also don't want to invest in things that involve a lot of speculation. You also don't want to invest in things that are, let's say, to some, harmful to the economy. Whatever will impact the human mind, cause any form of acting out of character. You don't want to invest in those kind of products. So if you say you want to buy a stock or share in a company, say maybe a company that produces alcohol, it might be assumed as you investing in a segment that causes humanity to act out of character. So you don't want to do that. You want to support humanity to exist the way they have been created to exist, believing in their capacities, in their abilities, and so on and so forth. You also don't want to, so just those three things. It's guided by three principles. So it is investing in the sense that investment. However, it is just guided by these three principles. Just avoid these three things. Halal funds invest in the economy or in assets that are anything that does not come back to these three things we've discussed. So that's why you find halal funds in a lot of infrastructure developments. So now halal funds are bringing out your money, putting it in an underlying asset, either to grow the economy or to help a person. Maybe you want to buy something and someone helps you get that item and so on and so forth. And that thing has to be something of value. It also should be something that maybe at the end of the day, you will be able to derive value and maybe give me, the person who provided you that opportunity, some sort of profit.
Okay.
If I put it that way, simplified, that's what halal investing is. So you see halal funds used to do a lot of infrastructure because that now is the most obvious asset that a person can point at to say, oh, this is what my money was used for. You see it in building of roads, where you see Sukuk 1, Sukuk 2, and so on and so forth. You see it in the building of things, because that way I can easily appease my conscience that this was what my money was used to do. So,
okay. So how have halal funds performed over time, especially during, times of economic uncertainty?
I'll say halal funds have performed well, and not just that, it is increasing in popularity. Why it is increasing in popularity, in my opinion, is because of the certainty that it sometimes provides. Because it is not interest based, the whole idea is to share profit. So from the get-go, while we're getting into this contract we're discussing, we're saying, okay, this is how much I'm going to return to you at the end of the day. So economic upturns, downturns, side turns, doesn't change that. So you don't come back to me to say, okay, last night there was a change in interest rates. That has nothing to do with you and I. So it creates certainty. It aids budgeting. So the economy is, a lot of persons subscribe to it mainly because of these characteristics. They're able to budget, they're able to plan. If I'm owing you 100 naira, I'm owing you 100 naira. So we won't say for some reason, fiscal policies and so on and so forth, I'm not owing you 200 naira. So all of those increments in debt portfolio or debt profiles are now avoided, to put it that way, yes.
But then again, how do halal funds then tie into diversity and hedging? Because I know for if certain I guess types of investments or types of assets or types of businesses are excluded, I'm just reasoning that could shrink the pool that halal funds are able to use to diversify. So that's one thing. And then the other thing is hedging. And like you spoke about options, right? So now we're talking about, let's say, managed funds now. So we're assuming that they know what options are, they know what they're doing, right? Options are, to the best of my knowledge, a speculative asset or security. So halal funds may not want to do that. So given all the principles that guide their investing, how does that not tie in? How do they not handle diversification and hedging?
All right. So for halal funds, what is done is that specific kinds of products that are monitorable are created. For example, you would not find something like treasury bills as a halal product, you as an outlet for halal funds, because in that sense, you will be handing money over to someone else to say, go do something and trust in what they have to say, in as much as there has to be an aspect of trust. But to talk about hedging and then to talk about diversification, there are a plethora of things out there. All you need to do is to select carefully that these things are not under any of these three classes that we have talked about, and you're good to go. So diversification, is still very, very possible. You can talk about roads, real estate in any shape and form, except of course, real estate for hotels where certain activities that encompass all the other three. So, but there are tons of hotels. They're called dry hotels. So they don't, some of those things are not there. And then you can also talk about bonds in corporates. Now, those kind of corporates where you have other things, energy, and so on and so forth, done there.
Don't corporate bonds pay a coupon? That's interesting.
Corporate bond, they do pay coupons, but it is the structure.
Okay.
So those bonds have a specific structure. They're called Islamic bonds, to use the word. Yes, they have a structure. So, and with those structure, you can, tell if or not this will be a halal product or not. So yes, it's becoming quite popular, and it is aiding to an extent the economy and the financial sector. It's aiding.
So it sounds like halal products can be used to make macroeconomic bets. because I know I was reading the other day, and there's like different types of investing: value investing, which Warren Buffett's pioneers, and then there's macro investing, which people like Stanley Druckenmiller and Ray Dalio, where you make bets on where you think the economy will, will move towards. So if I think, okay, if maybe a particular country is on the rise, or maybe during a speech, maybe when you're talking about the budgets, and they say, oh, maybe the president says he's looking to make more investments in the power sector. So I'm just thinking, as an investor, can I not think, okay, is there a halal fund that maybe finances infrastructure projects in the power sector and then invest in that? Is that something that halal products can be used for?
Well, yes. Why not? You can actually, because for the investor, the main concern for the investor who is going to go to halal fund is just to avoid those three things we've mentioned. So it now tells you to some extent that everything else can be done. It can be utilized to, invest in a certain sector. It can be utilized to, take up certain assets. Yes, you can use, you can do that. You can begin to predict ABCDE when it comes to certain assets and sectors if you're thinking about halal funds. However, they are not betting per se.
Okay.
Yes, it's as though you are invested in a particular sector. I could say, okay, I am concerned, I would rather, participate in energy, and all of that. So it's now based on the decisions I make for my society. So based on that, I could stick to that investment class and go with it.
Let's tie everything together, right? Because you said quite a bit, right? The point is, we want to build a resilient portfolio. All right, so you have 5 million today. Boom, 5 million appears in your account. All right, Angela, please build a diversified portfolio with that 5 million for us.
All right. So with my 5 million, the first thing I'm going to do is, of course, not to run to liquidity. The first thing I would do is to go for fixed income investments, because first off, that is security. It tells me that at certain points in time, I'm going to get certain amounts of money, over time. So I'm going to go first, use say 40% of that, go into fixed income. So in that fixed income, I'm going to buy bonds, but now not one person's bonds from different, and all of that. So once I've done that, the next thing I will be considering with a smaller amount, but yes, that will be my next choice. It will be equities. So I begin to buy shares because that's where I expect the most profit from. Fixed income is not profit, it is security. So then the next thing I will do is equity, because with movements in the stock market, I can make quite a lot if it's well done. I will buy shares here and there, different, and all of that, maybe buy some ETF and so on and so forth. So when that is done, the next thing I'm going to do is to hedge with what is left, so that when that time comes, I will be able to gather what is left of me and survive that endeavor of investing. So that's what I would recommend. I would say in that portfolio, or that's what I'll do. In that portfolio, I will have fixed income, I'll have equities, and I will most definitely hedge. Then of course, the last thing, which is going to be a small part, maybe 5%, will be liquidity. Because like we said, you need to remain liquid. Life is going to happen to you. You would need to pay for it. So I would have some bank placements. I have maybe a placement in the bank, something that is near to cash. That's it I do.
Yeah, I like how simple that is. I thought I was going to hear, I'm going to do this infrastructure and do this and that and that. But I like that, your head has, sometimes some of the best answers or best solutions are the simplest ones. And now, of course, this is what Angela would do. We're not saying this is what you should do, but yeah. Thank you so much, Angela, for coming on the show and just walking us through resilience. And there you have it. Resilience is not avoiding risk, it's managing risk, right? Diversification, liquidity management, and hedging are three things you need for a resilient portfolio. Now, of course, thank you for watching our show. Follow us on all our social media platforms. And as always, stay safe in the markets.